Welcome to the Byte-Size Brief. Today we are putting Webull BULL completely under the microscope. Let's get into it.
Yeah, it is definitely time we unpack what is going on here.
Seriously, because, imagine waking up, you pour your morning coffee, you check your brokerage app, and a stock that has just been agonizingly bleeding out for months suddenly explodes by double digits.
Right, and the options volume is just spiking by, 78%?
Exactly, 78%. And the Reddit boards are absolutely screaming. So, you sit there wondering, is this just a dead cat bounce, a temporary sugar rush, or did the smart money just entirely flip the script while everyone else was looking the other way?
It's the multi-million-dollar question right now.
For everyday retail investors, April 2026 has just been an absolute wild ride. If you've been holding Webull BULL, you definitely know the pain.
Oh, absolutely.
It suffered this brutal year-date decline, washing all the way down to the $5.82 range.
Yeah.
It left a lot of loyal shareholders incredibly frustrated.
Very frustrated.
But then, out of nowhere, we get this massive single-session rally. So the mission of our deep dive today is to really unpack the underlying machinery of this sudden resurgence. We need to figure out if the fundamental business model is actually turning a corner.
And to figure that out objectively, we really have to strip away the social media noise. We need to focus strictly on the underlying architecture of the move.
Right. Hard data only.
Exactly. We'll be tearing apart the most recent SEC filings, breaking down the quarter-over-quarter financial realities, and tracking where the institutional order flow is actually moving. We are going to map out the mechanisms driving the price action, not just, reacting to the momentum.
But, that momentum didn't just come out of thin air, though. The data points to two massive immediate news catalysts that really triggered this double-digit rally.
Yeah.
Let's explore the mechanics of what just happened.
Okay, let's do it.
So the first piece of the puzzle is this regulatory tectonic shift. The SEC just eliminated the pattern day trader rule, which, is commonly known to anyone who has ever tried to grow a small account as the PDT rule.
Yeah, the elimination of that rule, it fundamentally alters the landscape for retail brokerages.
Really?
To understand why this is such a powerful catalyst, we really need to look at the mechanics of the PDT rule itself. Historically, if you were a retail trader with a margin account, the SEC required you to maintain a strict minimum balance of $25,000.
Which was a massive thorn in the side of the everyday investor.
It really was. If you dropped below that 25 grand, you were legally prohibited from executing more than 3-day trades in a rolling 5-day period.
Right. It locked smaller accounts out of active intraday risk management. If the market turned against you on your 4th trade of the week, you were trapped in that position overnight because the system literally wouldn't let you sell until the next day.
Exactly. It was originally implemented decades ago to protect unsophisticated investors from rapid-fire losses. But, in the modern era of zero-commission trading, it essentially functioned as a wealth gatekeeper.
Yeah, exactly.
And that restriction was directly bottlenecking Webull BULL's core business model.
How so?
Well, if you look at their platform interface, it isn't designed for the passive buy-and-hold index fund investor. It's heavily engineered with advanced charting software, level 2 market data, and complex options analytics.
Right. It's an ecosystem built specifically for high-frequency engagement.
Precisely. So by removing this $25,000 barrier, the SEC didn't just tweak a regulation, they instantly expanded the total addressable market for the company's most profitable segment. Millions of smaller accounts that were previously forced to just, sit on their hands can now execute as much daily volume as they want.
Wow. That opens the floodgates for transaction volume. But, expanding the user base only matters if the shareholders...
Right, the financing shift.
Yeah, there was a major subtle shift in how Webull BULL is financing its operations.
Yeah, and this second catalyst is entirely internal and heavily impacts the fundamental valuation of the stock. So Webull BULL officially terminated a $1 billion standby equity purchase agreement, or a SEPA.
With an entity called Yorkville, right?
Yes, with Yorkville. Now, a SEPA is often viewed by the market as a mechanism for toxic financing. It allows a company to raise capital by issuing brand new shares directly to a purchaser at the company's discretion over a set time frame.
Okay, so basically, it's kind of like having a giant money printer in the basement that management just agreed to unplug. Every time they print new shares to pay their bills, the regular shareholders' slice of the company pie gets thinner and thinner.
The math on that analogy holds up perfectly. The constant looming threat of that dilution, it was acting like an anchor on the stock price. The market knew that Webull, B-U-L-L, had this massive $1 billion facility just sitting there.
Even though they hadn't used all of it, right?
Right. They had only utilized a fraction of it. They issued about 11.5 million shares to raise $173.2 million. But the theoretical capacity to just flood the market with new equity, it terrified long-term investors.
So pulling the plug on April 6th was a huge deal.
Exactly. With no outstanding amounts owed, management entirely removed that specific structural overhang. The market reacted violently upward because, well, killing a SEPA is the ultimate signal of corporate confidence.
It tells Wall Street they don't need the money printer anymore.
Exactly. It says management believes their internal cash flow is strong enough to fund global expansion without constantly going back to the well to dilute existing shareholders. Now, it is important to contextualize this by noting that other retail platforms, like Robinhood, are also experiencing a surge in trading activity due to these broader SEC regulatory shifts.
Right, but what does all that actually mean for Webull BOL investors? If the whole sector is getting a regulatory tailwind, how does this specific company capture that value?
Well, they capture it through their specific platform retention strategy. Because while broader market rules do lift the entire sector, Webull BULL is uniquely positioned because of the SEPA termination.
Right, the double whammy.
Exactly. They have removed the primary reason institutional investors were avoiding the stock. Right at the exact moment, their highly active user base has been unchained by the SEC. They have a clear runway to monetize that engagement.
Okay, so compared to last quarter, what actually moved the needle here? Because, a regulatory win is great, and stopping the dilution bleeding is fantastic, but we have to look under the hood.
We do.
Does the actual balance sheet support a double-digit stock rally right now?
If we isolate the fourth quarter of 2025, the top-line growth is undeniably robust. Revenue came in at $165.2 million.
Oh.
Yeah, that represents a 53% year-over-year leap. And it actually cleared Wall Street's consensus estimates of $161.35 million.
Pushing 53% revenue growth in an environment where consumer discretionary spending is supposed to be tightening is incredibly impressive. I mean, it shows they aren't just surviving, they are actively pulling market share away from legacy brokers.
The asset accumulation metrics really reinforce that narrative, too. Total customer assets on the platform hit an all-time high of $24.6 billion.
$24.6 billion, that's huge.
It's an 81% increase compared to the previous year. And furthermore, they secured $8.6 billion in net deposits for the full year. So the data tells us users aren't simply opening empty accounts to look at the pretty charts. They are wiring in serious capital.
Yeah, and I was digging into their operational reports, and there's a massive emphasis on their new AI integration. They launched this trading assistant named Vega.
Right, Vega.
The user data on it is staggering. Vega is actively assisting 1.2 million users every single week and has already processed over 10 million complex market queries. It feels like they are moving away from just being a transaction portal and trying to become like an automated financial advisor.
To create a massive switching cost.
Exactly. If the AI learns your trading habits, you are much less likely to pull your money out and go to a competitor.
That technological ecosystem is exactly what is driving that 81% growth in assets. But we really have to pivot to the darker side of the ledger here, because acquiring those assets is burning a massive hole in their profitability.
Uh-oh. Here comes the bad news.
Yeah. Despite that impressive 53% revenue jump, their fourth quarter earnings per share came in at just 3 cents, which completely missed the analyst estimate of 5 cents.
Oh, wow.
And even more concerning, their net income actually contracted slightly. It dropped to $14.6 million from $14.9 million the prior year.
Well, if they are pulling in over 50% more revenue, how is their actual take-home profit shrinking? Where is all that extra cash evaporating to?
It is being incinerated in their user acquisition funnel.
Really?
Yeah. If we scrutinize the fine print of their SEC 20F annual report, marketing and branding expenses more than doubled in the fourth quarter. It hit $53.3 million. But the true cash drain is an accounting line item known as Contra revenue.
Okay, let's break that down, because Contra revenue sounds like obscure accounting jargon, but it's actually the most important concept for understanding their business model right now.
Mechanically, Contra revenue is money that gets deducted directly from their gross revenue before they even report the top line number. In the context of Webull BULL, It represents the aggressive promotional giveaways.
Ah, right.
It is the cost of the free fractional shares, the cash deposit bonuses, and, the yield incentives they dangle to convince users to move their portfolios over.
So how much are they actually spending on that?
Well, in 2024, their Contra revenue was a modest $3.6 million. By the end of 2025, that figure had exploded by 485%.
What?
Yeah, to $21.2 million. And the acceleration is steep. Nearly half of that entire annual spend, $9.6 million, occurred in the fourth quarter alone.
Hold on, how does that actually affect Webull BOLL's stock price for regular investors like me? It sounds like they aren't organically growing their user base through superior software. They're essentially just bribing users to walk through the front door.
That's certainly one way to look at it.
Like, they are handing a new user a $20 bill, hiding it on the balance sheet as contra revenue, and hoping that user eventually generates $21 in trading fees.
That dynamic is the core friction point for the valuation. The explosive growth in customer assets to $24.6 billion is phenomenal, but the cost to assemble that asset base is severely compressing their margins. They are executing a highly aggressive, calculated land grab strategy.
They just want the market share at any cost.
Yeah, exactly. But the bill for that market share is the reason they missed their earnings per share target. It places a hard ceiling on the stock's potential until management can prove they know how to pivot from simply buying users with free stock to actually monetizing them efficiently.
It's the classic Silicon Valley tech dilemma. Scale at all costs today, figure out how to actually turn a profit tomorrow.
Precisely.
But the cash burn isn't the only existential threat hidden in these SEC filings.
Right.
We need to talk about the plumbing of how they actually make their money. We need to talk about payment for order flow.
Yes. Payment for order flow, or PFOF, is arguably the most critical vulnerability in their entire operational model.
It's a huge deal.
According to their latest disclosures, PFOF currently accounts for 53.3% of the company's total revenue.
Over half.
Over half. That translates to an incredible $304.1 million for the year. To understand the risk here, you really have to understand the mechanics of the trade. When a retail user hits buy on Webull BULO, the platform does not send that order directly to the New York Stock Exchange.
Right. They send it to the middlemen.
Exactly. They route that order to massive wholesale market makers like Citadel Securities. The market maker executes the trade and, in exchange for the right to handle that retail volume, pays Webull BULL a fraction of a penny per share.
And regulators despise this practice. They view it as a massive inherent conflict of interest. Like, the SEC's argument is that if a market maker is willing to pay Webull BULL for the order, that market maker is profiting off the spread.
Which means the retail investor isn't actually getting the absolute best available price.
Right. They're getting scalped for micropennies that add up to hundreds of millions of dollars for Wall Street.
And the regulatory scrutiny is relentless. Webull BULL's own risk disclosures explicitly warn investors that if the SEC pushes through stricter regulations on PFOF or bans the practice entirely, as they have fiercely debated doing in recent years, the company's financial foundation would be heavily compromised.
Because it's over 50% of their revenue.
Because they derive more than half of their revenue from this single practice, yes. They are vastly more exposed to regulatory shifts than diversified legacy brokers who rely on wealth management fees or interest income.
Okay, so we have established a very complex reality here. The financials show explosive, undeniable growth in revenue and user assets, but it comes with a massive cash burn rate and a regulatory sword of Damocles hanging over their primary revenue stream.
It's a precarious balance.
It really is. And this is where the story gets truly fascinating. How is the open market digesting these conflicting realities? Like, if we look at the tug of war between retail sentiment and institutional money flows, the divergence is staggering.
The contrast between the retail community and the institutional players is one of the starkest anomalies in the market right now. Let's start with the retail perspective you've been tracking.
Oh man, if you spend any time reading through their RW Bull Stocks subreddit, the atmosphere is toxic. Retail investors are suffering from a massive meme stock hangover.
Right, because of how it originally debuted.
Exactly. Remember, this stock originally came to market, went absolutely parabolic on pure hype, and then brutally crashed. The everyday investors who held on are incredibly frustrated. You have thousands of retail traders holding heavy bags with an average cost basis sitting way up around $12.50.
And it's currently trading at half that.
Yeah, they look at the current price pinned near the $6 level, and they just feel trapped.
The prolonged downward price channel has completely exhausted their psychological capital.
It's beyond exhaustion, honestly. It's active resentment. They're furious about the historical dilution. They are venting about the stock-based compensation packages being paid out to executives while the share price just bleeds. The everyday retail trader, the exact demographic that uses the app, seems completely burned out on the stock itself. They think the company is a sinking ship.
But if we shift our focus away from the retail message boards and look strictly at Wall Street's mandatory 13F filings, a completely opposite narrative is playing out in the shadows.
This is the crazy part.
While the retail crowd is capitulating and selling at a loss, institutional money is quietly, aggressively accumulating shares. In the most recent quarter, institutional ownership of Webull, BULL, jumped by almost 60%.
A 60% jump while the stock is making fresh lows.
Exactly. Institutions now hold over 157 million shares of the company. We are not talking about small hedge funds here either. We are seeing massive, sophisticated Wall Street titans getting heavily involved. Firms like Citadel, Jane Street, Susquehanna, and Coatue Management have taken significant positions.
That's heavy hitter money.
When institutional algorithms and fundamental analysts decide to increase their collective holdings by 26 million shares in a single quarter during a heavy downtrend, it signals they're modeling a long-term intrinsic value that the frustrated retail crowd is entirely missing.
I have to play devil's advocate here, though. Couldn't you argue that firms like Citadel and Susquehanna are massive market makers? Aren't they just buying shares to hedge their complex derivatives books?
That's a fair point.
Like, if I am a market maker heavily shorting a stock, I might buy millions of shares just to remain delta neutral, not necessarily because I believe the underlying company is going to succeed.
That is a highly astute challenge, and it's exactly why we have to look past the common stock purchases and examine the options chain. The options data definitively proves this is not just a defensive hedge.
Oh, really?
Yeah. The open interest, which is the total number of outstanding derivative contracts that haven't been settled, is heavily disproportionately skewed toward call options.
Calls, too.
These are aggressive, bullish bets that the stock price is going to rise significantly. And they aren't buying calls near the current price. The heavy volume is clustered way out of the money in the $10 to $16 range.
So they are buying the right to purchase the stock at $16 when it is currently trading around $6. That is an incredibly leveraged, highly confident bet on massive upward momentum.
Furthermore, if we look at the options Greek known as implied volatility, the metrics are off the charts. Implied volatility is essentially the market's expectation of how violent a stock's future price swings will be. Right now, the options market is actively pricing in a 20 to 25% move by early 2026.
Wow, 20 to 25%.
Take that a step further and look at the max pain level. Think of max pain like a casino, setting the odds so that the house pays out the absolute minimum to bettors.
Right.
It is the specific price point where the maximum number of options contracts expire completely worthless, allowing the option writers, the market makers, to pocket all the premiums. The max pain level for the near-term monthly expirations is currently sitting way up at $12.50.
So to synthesize the institutional data here, Wall Street isn't buying downside put protection. They aren't betting on this company going bankrupt. They are aggressively buying upside calls, targeting double-digit price targets, and mathematically positioning for explosive upward volatility.
That's what the data suggests.
They're looking at the 53% revenue growth. They're looking at the $24.6 billion in user assets, and they are completely shrugging off the short-term marketing cash burn. They view the Contra revenue not as a permanent flaw, but as a temporary necessary cost to capture territory in a brutal sector.
The institutional thesis appears to be that the structural headwinds have finally cleared. Webull, BULL just killed a billion-dollar dilution machine. The SEC just removed the regulatory handcuffs holding back their core high-frequency traders, and they are operating with an 80% gross margin profile.
Right.
The institutional money is betting heavily that management will successfully flip the switch from aggressive user acquisition to massive cash flow generation.
So, as we pull all these complex threads together, what is the ultimate takeaway? Webull BULL is one of the highest tension stories in the financial markets today. You have a digital brokerage commanding a massive 26 million strong global user base.
A massive footprint.
Their top-line revenue is exploding by 53%, user assets are swelling by 81%, and their AI integration is driving millions of daily interactions.
But counterbalancing that, you have a business battling severe profitability compression. Their marketing costs have doubled, their promotional giveaways have spiked by nearly 500%, and their fundamental reliance on payment for order flow keeps them perpetually in the crosshairs of federal regulators.
It is a high-growth, high-cost, incredibly high-stakes game of financial chess. Which brings us to a final provocative thought to leave you with. We know Webull, B-U-L-L, is actively executing a massive global expansion into 14 distinct international markets.
Including heavy-hitting economies like Japan, the United Kingdom, and Canada.
Exactly. So as you evaluate this company's future, consider this. Can their highly engineered AI-driven platform generate enough organic loyalty to outrun the intense regulatory scrutiny tied to their heavy PFOF reliance and their Chinese corporate origins?
Can they achieve true global scale before that massive marketing budget inevitably dries up and they are forced to prove they can turn a real unsubsidized profit?
It is the multi-billion-dollar cushion underlying every single trade on the platform right now. If management can cleanly navigate the pivot from buying growth to harvesting profit, the massive institutional bets in the options market will yield historic returns.
But if they fail to monetize that engagement, the bitter frustration of the retail traders holding the bag at $6 will be entirely validated.
So as you look at your own portfolio and weigh the hard data against the market sentiment, whose side are you taking? Are you siding with the burned retail traders or the institutional heavyweights? All right, listeners, what's your take on the future of Webull, B-U-L-L? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.